Long before Isaac Newton got bonked on the head by an apple, people already knew one universal truth. What goes up must come down. And nowhere is that more true than the economy. Booms turn to busts, bubbles pop, and fortunes vanish overnight. Today we're looking at the 5 worst financial crashes in history. Let's go. One that I'm sure you're all too familiar with is the Great Depression. The Roaring Twenties had created a booming stock market. The United States, it was flexing its economic muscles and emerging as an industrial powerhouse. What's more, ordinary Americans were able to start interacting with Wall Street, often buying shares on margin. Now, instead of paying full prices for stocks, investors could just put 10% down and borrow the rest from their broker. And this worked for a while. But on October 24th, 1929, Black Thursday, stock prices began to plummet. And just a few days later, on October 29th, Black Tuesday, the market completely collapsed. Between September and November of 1929, the stock market lost more than $30 billion in value, nearly 10 times the federal budget at the time. Thousands of banks failed across the United States. Unemployment hit 25%, and global trade shrank by over 65%. And families, they saw their life savings disappear overnight. And with no government protections in place, if your bank failed, you were simply out of luck. The world only began to recover after another massive shock, which was World War II, which forced economies back into high gear, but millions of lives had already been changed forever. And in a direct response to the Great Depression, the United States government created lasting reforms, which were Social Security, FDIC insurance, and modern monetary policy. If you want a more in-depth analysis on the Great Depression, then check out this video. Considered the world's first Ponzi scheme, in the early 1700s, Britain was climbing out of war debt and searching for new ways to fuel its growing empire. Along came the South Sea Company in 1711, founded by an act of parliament which promised enormous profits from trade with South America. Now the pitch was irresistible. Exclusive trading rights with Spanish colonies, plus a chance for ordinary people and even nobles and members of parliament to get rich quick. Therefore, shares of the South Sea Company skyrocketed as investors piled in. But behind the excitement, there was a problem. For you see, the South Sea Company wasn't actually making money. In fact, it barely had any real trade at all. The entire boom was driven by speculation and hype. For you see, there was a big thing that people failed to realize. Britain was at war with Spain, which controlled most of South America at the time, so in reality, almost no trade ever happened. Even when the war ended, profits were nominal as Spain severely limited Britain's trade access and taxed them heavily. So eventually, reality caught up and the bubble burst. By the end of 1720, shares collapsed back under £100. Fortunes evaporated overnight, and thousands of investors were ruined, including some of the wealthiest and most powerful in Britain. Even the legendary scientist Isaac Newton was caught up in the frenzy. After losing a fortune, he famously remarked, "I can calculate the motions of the heavenly bodies, but not the madness of men." Arguably the worst financial crisis since the Great Depression, the 2008 meltdown is something that still affects people to this day. So if you're around my age, definitely go and ask your parents how much their 401ks lost during this time. It's probably going to be an awkward conversation. But anyway, the actual crash started with the housing market. The root cause of it was something called subprime mortgages. Now these were loans given to borrowers with poor credit histories who normally wouldn't qualify. But the lenders didn't care. These risky mortgages were bundled together and sold to investors as mortgage-backed securities. And for banks, it looked like all the profit and none of the risk, at least for a while. In the early 2000s, home prices were climbing and everybody wanted to get in. But by the end of 2006, prices stopped rising and cracks started to form. Borrowers couldn't refinance or afford their payments, so they defaulted. Banks foreclosed, flooding the market with unsold homes. Supply overwhelmed demand, and soon homeowners owed more on the mortgages than their house was actually worth. The financial system began to crumble. First, Bear Stearns, it collapsed in March of 2008, then Lehman Brothers in September. After that, the panic went global. Housing prices tanked, banks froze lending, stock markets crashed, and millions lost their jobs, homes, and retirement savings. Trillions in wealth evaporated. Now, governments rushed in with unprecedented bailouts. The Federal Reserve and other central banks printed money on a massive scale just to keep the system alive. And out of the wreckage came reforms like Dodd-Frank, which placed new regulations on banks to prevent reckless lending. However, for many people, a deep mistrust of Wall Street still lingers today. By the mid-1990s, Southeast Asia was being hailed as an economic miracle. Countries like Thailand, Indonesia, and South Korea were growing at breakneck speed. Foreign investment poured in, stock markets soared, and it seemed like nothing could slow them down. But much of this boom was built on shaky foundations. Currencies were pegged to the United States dollar, debt levels were rising, and capital was flowing in much faster than the economies could handle. Then in July of 1997, pressure mounted on the Thai baht as investors began to doubt the government's ability to maintain its peg with the US dollar. And they were right. Thailand ran out of dollars to defend their currency and was forced to float the baht. And almost overnight, it collapsed, sending shockwaves around Asia. Stock markets plunged, currencies tumbled, and economies that had been growing at double digits suddenly went into freefall. Indonesia's economy contracted by a staggering 13% in a single year. Businesses collapsed, millions lost their jobs, and political unrest broke out. South Korea and Malaysia were also hit hard, sparking widespread fear of total regional meltdown. The International Monetary Fund had to step in with over $100 billion in emergency bailouts, but these came with strict austerity measures that made the pain even worse for ordinary people. The crisis eventually reshaped Asia's financial systems and served as a warning about the dangers of rapid growth, fueled by debt and speculation. The late 1990s was the Wild West of the internet age. Many investors believed that the internet was going to change everything overnight. So many startups with just a dream and maybe a website found themselves being worth billions of dollars just because they had a .com in their name. Money poured into the sector, stock prices soared, and the NASDAQ tripled in value in just a couple years. And tech conferences? Well, they seem more like gold rushes than actual business meetings. But reality eventually caught up, because many of these companies had no profits, no real business plans, and in some cases, no products at all. And when investors realized the hype couldn't last, the bubble burst. The NASDAQ lost nearly 78% of its value between 2000 and 2002, wiping out trillions in wealth. Thousands of companies went bankrupt, retirement accounts were gutted, and countless investors saw their fortunes vanish. One of the most infamous examples was Pets.com, which spent millions on a Super Bowl ad and then burned through $300 million in less than a year before going bankrupt. But while most .coms disappeared, the crash cleared the field for survivors like Amazon, Google, and eBay, companies that proved the internet really was revolutionary, just not on the timeline that investors had imagined. The .com crash remains a classic example of how hype and speculation can inflate the markets far beyond reality, until inevitably gravity pulls them back down to earth. Throughout history, from the South Sea bubble to the .com crash, the story has always been the same. Booming optimism, a rush of speculation, and then a brutal crash when reality finally hits. While the details change, tulips, railroads, internet stocks, or subprime mortgages, the human behavior driving it rarely does. Greed, fear, and the belief that this time it'll be different. These things keep repeating. Financial crashes are painful, but they also reshape economies, create new rules, and sometimes even clear the way for real innovation. History shows that while bubbles burst, progress never stops. So the next time you see markets soaring and everybody trying to chase easy money, just remember one thing. Gravity always wins. And with that, I'm Evan, and thanks for watching. If you liked what you just saw, then click on the video here. Also, if you haven't, like, subscribe, and hit the bell icon so you don't miss any future videos.